The US dollar has settled at a 6-week high against the major currencies on the back of upbeat macroeconomic data and the expectations of a more aggressive monetary tightening by the Fed Reserve. Investors increased their Fed rate bets. They expect the central bank to raise the funds rate by 50 basis points at the next policy meeting. A batch of recent data still indicates high inflationary pressure in the robust labor market that set the stage for sharp rate hikes. Now let's discuss what other reports are due at the end of this week and how they could change market sentiment. On Thursday, market participants will be able to judge on changes in the inflation dynamic in the Eurozone, as they will get to know the revised CPI for January. According to flash estimates, the annual inflation rate slowed down to 8.5% last month from a 9.2% in December. Importantly, this data did not allow the CPI for Germany because of technical glitches in data processing. Thus, the final reading is likely to differ from the preliminary one, because Germany locked a rise in energy prices after the term of the one-off state subsidy in electricity bills expired at the end of 2022, so inflation in Germany again jumped to record highs. If the Eurozone CPI comes in higher than the projected 8.5%, traders will open long positions on the euro, awaiting resolute policy moves from the ECB in the fight against high inflation. Otherwise, if the actual CPI matches the forecast, we should expect the opposite dynamic. The euro will weaken. Market participants will be able to revise the outlook for the US currency, looking at the US initial unemployment claims, which are released on February 23. Once again, analysts predict an increase of 200,000 claims. Previous reading undershot the key around level of 200,000, hovering highly at a 9-month low. This proves an extremely tense labor market, which forces employers to raise wages to encourage hiring or keep personnel interested. In turn, this opens the door to inflation acceleration, so the Fed Reserve will have to respond with the aggressive rate hikes. Let's see whether the trend in the jobless claims changed in the week ended February 18. Investors will take notice of the inflation data from Japan as well. The annual CPI is expected to update a 30-year high. Consumer prices are developing at a fast pace due to precedently rising import prices and the weak yen, which has lost its luster among traders in view of the ultra-loose monetary policy by the Bank of Japan. Despite inflation acceleration, Japan's monetary authorities refrain from any rate hikes. No wonder traders prefer the US dollar to the yen because of the difference in the monetary policies of the central banks. Traders will be alert to a speech by KAZUO UEDA, who will replace Haruhiko Kuroda as the Bank of Japan's governor. The new central bank boss will deliver a speech on Friday. Earlier, Mr. Ueda said that he also advocated for the ongoing dovish case of monetary policy, so he's likely to maintain the key interest rates at minus 0.10%. Such prospects are bearish for the yen. At the end of the trading week, the report of a major importance, the U.S. personal spending, will be on investors' radars, following a 0.2% dip in December. Analysts foresee recovery in consumer activity in January. The indicator could have rebounded by 1.3% from a month ago. Importantly, almost two-thirds of the U.S. gross domestic product is generated by consumer spending. That's why this indicator shed light on economic prospects and is closely watched by the market to check whether recession risks are realistic. Strong consumer spending will certainly encourage traders and revive the appetite for risk. As a result, risky assets will gain ground. We will monitor the market reaction to the above-mentioned reports. Subscribe to our channel and follow changes in market sentiment with us. Any comments, questions and offers are welcomed. We wish you profitable trading and see you soon.